Structured credit has evolved dramatically since the financial crisis. What was once associated with opaque risk has become a critical tool for banks, insurers, and institutional investors looking to optimize capital transfer risk and access new sources of yield. Today's structured credit market is more transparent, more regulated, and far more nuanced than the version many people remember from 2008. At the heart of today's market is synthetic risk transfer, often done through significant risk transfer (SRT) transactions, credit-linked notes (CLNs), or bespoke structured notes. These structures allow banks to transfer a defined slice of credit exposure to investors whilst retaining the underlying asset on their balance sheet. So why does this matter? Well, because it frees up regulatory capital. Under Basel rules, banks must hold capital against credit risk. By transferring a mezzanine or first loss tranche to investors, banks significantly reduce the capital required, improving balance sheet efficiency. For investors, structured credit provides access to exposures that aren't available in vanilla markets. A mezzanine tranche on a diversified corporate loan portfolio might provide mid-teen yields with risks that can be modelled through correlation and scenario analysis. Understanding these structures requires analysing not just default risk, but tranche thickness, attachment and detachment points, correlations, assumptions, and embedded triggers. Correlation is a key factor. In stressed markets, implied correlation across credit portfolios typically rises, meaning default clusters more tightly in downturns. This dynamic can disproportionately widen mezzanine risk premiums compared to senior risk. For sophisticated investors, this credit creates opportunities. When correlation spikes, mezzanine tranches may become undervalued relative to their true long-term risk. Regulation has reshaped the landscape. Post-crisis reforms require clearer disclosure, standardized documentation, and more rigorous modeling. The market has shifted from opaque CDOs, squared structures, to simpler, more transparent deals tied to real underlying exposures, often corporate loans, trade finance portfolios, consumer credit, or SME loans. Structured notes also serve corporates and institutions looking to fine-tune exposures. Callable structures, step-up coupons, and rate-link mechanisms can align liabilities or investment strategies with expected market conditions. Modern structured credit is not about hiding risk. It's about reshaping and redistributing it. Banks use these tools to manage balance sheets. Investors use them to access unique yield opportunities, and regulators use them as guardrails to ensure transparency. Understanding the mechanics of today's structured credit market unlocks insight into one of the most sophisticated corners of finance.